In this video, I'm going to discuss how to identify significant accounts and relevant management assertions when auditing the payroll cycle. Now, in our last video, we discussed the first step of auditing payroll, understanding the various activities that make up the company's payroll cycle. Once we understand how the company's payroll cycle works, then we can move on to identifying significant accounts and relevant assertions. So let's jump to it. What is a significant account? Well, remember, a significant account is an account where there's a reasonable chance there could be a material misstatement. Now, what does payroll have to do with? It has to do with paying employees for services rendered. Okay, some employees do some work, the company owes them money. So what are the accounts that are going to be affected? We've got the cash account. We have labor expense, which actually there are a lot of different types of labor expense, and that's going to be very important. Are we just talking about regular wages here? Are we talking about a sales commission? Are we talking about general and administrative expense? Is this an executive salary? If this is a manufacturing company, are we talking about a product cost or a period cost? Remember, for manufacturing, we have direct labor, then we have indirect labor, which is a type of manufacturing overhead, and then we have period costs, which are salaries and other costs that have nothing to do with manufacturing. So this is important because these labor costs and how we classify the labor costs could affect the manufacturer's inventory account, right? So if costs are improperly classified, for example, if we have some costs of manufacturing and we improperly classify those as period costs, that's going to affect the company's inventory account and its cost of goods sold. Obviously, if we're talking about a service provider is not going to have inventory, they're not going to have cost of goods sold, so those would not be significant accounts for the payroll cycle if you're doing an audit of a service provider. Now, payroll-related liabilities, we're thinking about things like the company has a liability related to payroll tax. So a company might understate the payroll tax liabilities. Now, another thing, so I don't have it in the list here, but I added it here at the bottom, stock-based compensation expense. So not all companies have stock-based compensation expense, but if a company is granting, for example, stock options to its executives, this often is going to be a significant account as well. The reason is that there's a lot of estimation and judgment involved in pricing, in determining, well, what is the value of that stock-based compensation that was granted to the executive? There's various pricing models that can be used. So it opens the door to fraud. Okay, so if there's a lot of stock-based compensation expense, that's going to be a significant account likely as well. Now, in terms of relevant assertions, so these are the significant accounts we're going to be thinking about when we're auditing the payroll cycle, but the assertions that are being made by management about payroll transactions and account balances is also something we need to be thinking about. Okay, so I've got a list here. So here's a list of assertions that management is making about account balances. Okay, for example, what are the payroll-related liabilities, the balances at the end of the period? And then I also have a list here of assertions that management is making about payroll transactions. Okay, so these are the different assertions. For example, when we look at account balances, management is making assertions about the existence of payroll-related liabilities. For example, they're saying that, in fact, this is a real liability. Okay, now you say, well, why wouldn't that be? What would be the issue? Well, what if you had someone at the company had created fictitious employees? Okay, and then the company didn't actually, that wasn't really a liability. Okay, so they had these fictitious employees. That actually gets into existence. That gets into rights and obligations. And also when we're talking about transactions, authorization. Okay, was it properly authorized that this fictitious employee, obviously the company wouldn't have given approval had they known there was this fictitious employee added to payroll. Okay, so if we have fictitious employees, then we're going to say, well, did these liabilities even really exist, or are these actually obligations of this company? Now, completeness is generally not as big an issue with a payroll, because if you think about it, if you are saying, okay, well, have all payroll transactions been recorded? Have we recorded all the payroll-related liabilities? Well, if you haven't, right, then some employees might complain, hey, I didn't get paid, right? Employees will come forward and say, hey, I didn't get paid here. And so they will complain. And so normally the completeness is not as big of an issue. However, when it comes to disclosures, the completeness assertion is very important, because if the company has a lot of executive compensation, particularly publicly traded companies in the U.S., When we get to executive compensation, there's a lot of disclosures that companies need to make about that. And then also the stock-based compensation that I mentioned before. Okay, so if we have a lot of stock-based compensation, executive compensation, there's going to need to be extensive disclosures that the auditor should go through. At the end of the audit, they're actually going to go through a disclosure checklist. Okay, so completeness is very important when it comes to the disclosures. Now, authorization, we want to make sure. So management is asserting that, okay, these transactions have been authorized. And you say, well, what do you mean? Well, for example, if an employee was paid $14 an hour, was that actually the authorized rate? And if an employee was an hourly employee and they were paid for 45 hours of work, did they in fact work 45 hours? Maybe they only worked 30 and they overstated their time or things like that. When it comes to accuracy and valuation, we're thinking about things like gross pay and net pay, and have they been correctly calculated? Remember, gross pay is the pay before any payroll deductions. After you take out the payroll deductions, then we've got the net pay. And we want to make sure, of course, that all payroll deductions have been properly authorized, and that's something that management is asserting. In terms of cutoff, we want to make sure all the transactions were recorded in the proper period. Classification is very important, and I already mentioned that with respect to what type of compensation expense is this? If we're talking about a manufacturer, is this a product cost or a period cost, right? Did we pay it's very different from a manufacturer, the compensation paid to an accountant for a manufacturer versus compensation paid to someone working on the assembly line. So wages paid to somebody working on the assembly line for a manufacturer is going to be direct labor, and that is going to go to inventory. And then when the inventory is sold, it's going to go to cost of goods sold. But if you have an accountant working for a manufacturer, that's going to be a period cost. And so that's just going to be expensed. The accountant does some work, you owe him money, you debit, salaries expense, credit salaries payable, is not going to flow through inventory and cost of goods sold. So we need to make sure that all the compensation has been properly classified when we have these transactions, that is properly coded to the correct accounts. So these are all the assertions that management is making about account balances and transactions. In the next video, we're going to talk about calculating the risk of material misstatement when auditing payroll.